First, I want to thank the organizers for putting our paper on the program and also for putting it in this session, because that was basically a wonderful setup for the direction that we're going to go here in terms of thinking about this paper. So this paper is with Zhang Yang and Tony, who I think many of you know. As we were just discussing, or similarly, the US government earns, or at least historically earned, what we're going to refer to here as a convenience yield on US Treasuries. That is, the rate on, or the yield on Treasuries is historically lower than other benchmark risk-free rates. Now, there's a lot of stories to this. I don't want to get too much into specifically how we want to think about this, but you could capture things like safety, liquidity, or regulatory advantage of holding scarce, safe dollar assets. Again, this has led historically to a funding advantage for the US relative to some benchmark risk-free rates, and as a result, seigniorage revenue for the US government. The seminal work of Arvin and Annette has shown that convenience yields do decline in supply of treasuries. Now, what are we going to be focused on here? In particular, we're going to be focused on the effects of long-run changes in supply of treasuries. So in order to trace out the effect of long-run changes in supply of treasuries, we're going to need to understand the actual long-run demand curves. That's going to require us to focus on identification. So we're going to need an instrument in this setting. We're also going to be focused on differences in convenience yields across maturities on US Treasuries. In particular, we're going to want to study the heterogeneity in the slopes of these demand curves for convenience on US Treasuries and their potential effect on the seigniorage revenue of the US government. All right, so let me just show you what our main focus is going to be, and then actually I am going to turn to the Treasury basis that we were just talking about similar before. Here I'm going to focus on a very simple thing for this particular talk. I'm going to take Treasury yields, and I'm going to take a maturity-matched LIBOR or SOFR swap. And I'm going to measure the convenience yield of maturity H on US Treasuries as the maturity-matched swap yield minus the yield on maturity-matched US government bonds. We're going to look at the entire market value of publicly traded Treasury bills. We'll focus on Treasuries, bills and bonds. We'll focus on maturities from about 1 to 20 years. There's some data details there. And then we're also going to construct government CIP data. Let me just show you a picture here, though. All right, so actually, let me start here. So historically, that convenience yield on US Treasuries was some positive number. That is, the maturity matched swap rate had a yield that was higher than that of US Treasuries. Here's a picture of that over time. I'm going to bucket into kind of 3 categories. I'll call it short-term, medium-term, and long-term. Think 1 to 3 years, 3 to 7 years, 7 to 20 years are the categories there. And this is that convenience yield over time. Of course, you can see a lot of fluctuations in that convenience yield over time. It spikes at various times. It spikes during the global financial crisis. But the main thing I want you to focus on for our purposes in this talk is the long-run trend in that thing. Right? You can see there's a long-run trend, both in long-term and in short-term convenience yields on US government debt, going pretty much, not always down, of course. There's a lot of upward and downward spikes on that. But in the recent period, long-term Treasuries and medium-term Treasuries actually have a negative convenience yield. Short-term Treasuries actually still have a positive convenience yield on the shorter end there. You can also see from this picture that long-term Treasuries have suffered kind of a steeper decline in their convenience yield than short-term Treasuries. Let me plot a slightly different picture for you here. What I'm going to do is I'm going to take the quantity outstanding of Treasuries within a particular maturity bucket, and I'm going to plot that quantity outstanding, or well, the convenience yield versus that quantity outstanding. Okay? And this picture illustrates the same thing that I was just saying on the previous picture. There's basically, you can think of this without identification, we'll get there in a second, as tracing out the long-run demand curve for Treasury convenience. Okay? And what you see there is as the supply has increased across all of these maturity buckets, the convenience yield on these US Treasuries has declined. More so for long-term Treasuries than for short-term Treasuries. So this is the focus of our talk here. We are focused in this particular paper on the long-run impact of increased Treasury supply on Treasury convenience. Okay, so how are we going to think about this? Well, first, of course, long-run Treasuries have basically, according to this picture, a steeper demand curve for convenience, right? Increases in supply have a larger effect on the convenience yield on long-run Treasuries than they do on short-run Treasuries. Now, of course, this picture has all kinds of issues, as I was pointing to, in the sense that this is prices on quantities, right? And so there's an endogeneity issue in this setting, and so we need to push a little bit harder on this. In the interest of time, I'm going to kind of just point out where we fit into the literature. There's a lot of literature thinking about these convenience yields. In particular, our focus here is identifying the long-run slopes of these demand curves for Treasury convenience and focusing on the heterogeneity in their slopes. This is going to have effects on U.S. exorbitant privilege that has been studied a lot in the literature, but I'll just leave it at that. We can discuss more. All right, let me show you this in regressions here. All right, so here's the OLS regression. We're going to focus on changes in the convenience yields, on changes in the supply of Treasuries of a particular maturity. All right, so you've got the short term here, and you've got the long term here. Those are just the slopes from the picture that I showed you before there. All of those are negative, but those coefficients aren't identified, right? So we want to focus on identification here to figure out whether there actually are differences in these slopes and what those slopes are over the long term. So we're going to need an instrument for Treasury supply. Why do we need an instrument for Treasury supply? Well, you could think about the endogeneity problem as, suppose that you get a very large demand shock, global financial crisis. There's a lot of demand for US dollar assets. That pushes up the convenience yield on US dollar assets. The US may be able to issue into that. Okay? So that's going to cause a big endogeneity problem in this regression potentially, and so we're going to want an instrument for Treasury supply in order to actually identify this. What are we going to actually undertake? Okay, so I just told you the endogeneity concern there. We're going to, again, we're focusing on kind of the long run here, so we need to come up with an instrument that allows us to focus on kind of the long run supply of Treasuries here. We're going to use this narrative approach from Romer and Romer, which had narrative, basically tax and policy shocks going up to 2008. We've just extended their procedure. What do they do briefly? They classify tax legislation into 4 categories: spending-driven, counter-cyclical, deficit-driven, and long-run growth. We're going to focus just on tax and policy shocks in this 4th category. Broadly, and I don't have a ton of time to go into it in a 20-minute talk, but broadly, the sort of thing that you see there is policy that says the economy is doing fine, politicians just want higher long-run growth, and so they're going to do something with tax policy, typically lower it, increasing future government spending. It also includes tax bills for reasons like philosophical, small government reasons. And what we do is we take the magnitude and timing of this from the CBO shocks, you get the tax policy, and then it has some future effect on spending over perhaps a 3 to 5 to 10-year period. And we use those future spending that is forecasted by the CBO as our shocks to Treasury supply. All right, so we're going to use that as an instrument for Treasury supply. We now run the same regression that we had before, but once you instrument for Treasury supply, you get a much clearer pattern coming out of that picture. Before, the coefficients were kind of fairly stable across these. Now what you see here is once you instrument Treasury supply using our instrument, that you get almost a 0 coefficient for short-term debt. The medium-term coefficient gets a bit more negative, and the long-term coefficient is even steeper. Right? So the demand curve is steeper for longer maturities. Quantitatively, what do these estimates tell us? This says that a 5 percentage point increase in long-term debt to GDP from its mean will imply a 0.72 percentage point decline in the long-term Treasury basis. Right? So this increased supply, especially on the long end, has substantial effects on long-term convenience yields on US Treasuries. All right, we also look at the Treasury basis, similar to what we were just talking about before. You can construct a synthetic dollar bond for a bunch of different currencies. We just talked about that. Compare that synthetic dollar bond to the yield on a maturity-matched US government bond. For the purposes here, we'll just take the G10 average Treasury basis and look at basically the same effects. Instead of comparing swap spreads, we'll compare synthetic dollar bonds. Here's the picture of that over time. Again, long-run trend with a steeper effect on the long end of the Treasury yield curve. Here's the supply picture that I actually showed you before, supply versus the Treasury basis across all of these. You see, again, short-term quite flat, long-term substantially steeper. And then finally, here's the IV. with the Treasury basis. Similar effects, basically kind of a fairly flat zero there on the short end, much steeper on the long end. All right, so foreign demand for longer maturity Treasuries is more inelastic. Quantitatively there, it's a 5 percentage point increase in long-term debt to GDP from its mean. Here, it means a 0.61 percentage point decline in the Treasury basis. All right, now we want to think a bit about the implications of this for government revenue, or in this particular case, government spending. All right, so far, let me just rehash. What have we shown? Long-term Treasury convenience yields are more sensitive to changes in Treasury supply than short-term Treasury convenience yields. We want to think about how this affects the seigniorage revenue of the US government. So we're going to do a fairly simple calculation. What we want to do is we want to measure how much investors give up to hold Treasuries. So our measure of seigniorage revenue here is just going to be the weighted sum of the convenience yield times the amount of debt outstanding in that particular bucket. Right? So you can compute the seigniorage revenue that the US government is getting at a particular point in time as just the convenience yield on some particular bucket times the amount outstanding and sum over that. Now, the assumption here, and there's kind of a big assumption, is that effectively if we're thinking of this as the seigniorage revenue of the US government's debt, it's basically under the assumption that the US could reissue the entire supply at those exact convenience yields. It's mostly just a matter of calculation to think how these convenience yields have changed over time and how that affects the US government's borrowing conditions, really as a function of supply. That's our focus of the paper here. All right, so what do we want to do? We want to take our identified estimates from those 3 different maturity buckets and understand how this increase in supply has affected the seigniorage revenue on US government debt. So what we're going to do is we're going to compute what I'll call counterfactual convenience yields. We're going to fix the convenience yield at the end of 2009 Q4. That's that intercept there. We're going to take our identified slopes from that IV regression. And then what we're going to do is we're going to compute counterfactual convenience yields across all of these buckets just due to the changes in supply. Right? There's, of course, all kinds of other things that can be moving these convenience yields. The example I gave and what we saw there before was demand shocks like the GFC that affected demand for US dollar bonds or US government bonds in particular. Demand shocks can't have an effect here. I just want to trace out how much the increase in supply has affected these long-run convenience yields. All right, so we compute these counterfactual seigniorage revenue. For our purposes here, I'm going to present the seigniorage revenue as a function of the annual interest expense of the US government. All right, so on the y-axis there, that's seigniorage revenue as a function of, again, annual interest expense of the US government, so in the realm of about 10% average. And the blue line on this picture, let's just focus on the left. That's the one from the LIBOR and SOFR swaps. Right, so that's the, and on the right is the Treasury basis. The blue line is the actual data, right? So the first thing that you see there, which is consistent with what I showed you before, is declining seigniorage revenue for the US government. It fluctuates a lot over time. The fluctuations there exactly reflect all the fluctuations that we saw in that first picture that were coming from potentially demand shocks and these sorts of things. So it's not to say that demand shocks and this sort of stuff doesn't matter for these convenience yields. Indeed, they do. You see a lot of fluctuation there. Our purpose here is to focus on this long-run effect of increases in supply in the face of downward sloping curves for convenience, or downward sloping demand curves for convenience. The red line on this picture is our counterfactual supply-driven one. Again, we fix it in 2009 Q4, and then we just trace out what the convenience yield change is due to increases in supply. And you can see here that the majority of this long-run decline in the seigniorage revenue of the US government can be explained by these increases in supply. Right? So basically, almost that entire long-run trend can be explained by this increases in supply, with a lot of fluctuations potentially coming from the demand side here. What's a natural response to that, potentially by the US government? I'm not going to say they're necessarily doing this, but you could imagine that they might be. The Treasury might be looking at different funding conditions. They might be saying, oh, there's funding conditions at long-term bonds, there's funding conditions in short-term bonds. You can adjust the composition. right? Of course, if you've got a steeper demand curve for long-term Treasury convenience, and you start to issue a lot more long-term Treasuries, that's going to push down the convenience yield and worsen the funding conditions in long-term Treasuries. On the other hand, the short-term one is quite flat. So one thing that we have seen in recent periods, actually, as we've traced down those downward sloping demand curves for convenience, is the Treasury has, at least in certain periods, increased the amount of issuance that they've done on the short end. It's varied a bit over time. So one natural response might be, okay, well, you've got a steeper demand curve for long-term convenience. Why not issue short-term? You could do that. We can actually compute the effect on the seigniorage revenue if the Treasury was to only issue in short-term bonds. Of course, that's going to have less of an effect on the seigniorage revenue because of the flatter demand curve there. If the Treasury were to issue all short, of course, the convenience yield wouldn't have gone down nearly as much. The red one is the same counterfactual I showed you there before. Now, that's not a free lunch, right? If you start to issue more and more short-term debt, you start to run into rollover risk and all of these sorts of things. So what we want to highlight here is this trade-off. You've got a steeper demand curve for long-term convenience than you do for short-term convenience. You could issue more short-term, but there's some serious risks associated with rollover risk and these sorts of things in terms of doing that. I'll just end on kind of a few implications. This is the one that I was basically just talking about. Treasury has shifted more short-term, but that has all kinds of trade-offs for the Treasury. Right? It also has some suggestions about the international role of US Treasuries and its reserve currency status. Look, I showed you a few results on the CIP basis. It shows significant shifts in international demand for US Treasuries. There's limited capacity to issue long-term Treasuries at favorable rates, as we've seen. And this could be related to potential decline in global demand for US Treasuries, and it would take more work and more models, impact dollars reserve currency status. There's interesting interactions here of these results with monetary policy. Unconventional monetary policy tends to operate on the long end. Other monetary policy tends to operate on the short end. As you think about reducing, for example, the Fed's balance sheet through our channel here, if you take it seriously, that's going to have larger implications on the long-term funding conditions as you reduce the Fed's balance sheet than it would on the short term. Has some implications for narratives of Treasury demand and models, but I'll skip over that. Let me just end with some concluding thoughts. So we've identified long-run slopes of Treasury demand curves by maturity. Demand for medium and long-term convenience yields are substantially more sensitive to supply than the short end is. Demand shocks clearly play a role at higher frequency variation in convenience yield. The long-run decline, largely, according to our calculations, appears to be much more supply-driven. Alternative stories here really require a driver that is correlated with the variation that is measured by our instrument, right? So this is why we went after this through an instrumental variable approach to really try to trace out the long-run effects of supply here. And the last thing, slightly suggestive, they suggest a reassessment of the US debt as a unique, safe, and liquid asset, especially given that these long-term convenience yields have started to become negative in the face of this increased supply. So in there, we're looking forward to Paul's discussion.
Okay, so let's jump into it. So I'm Paul from Chinese U. Thank you to the conference organizers for asking me to discuss this paper. So I give you sort of my quick overview of how I think about the paper. And then I'm going to have a series of probably not so well thought out comments. So I like the paper because it's a big picture paper. It's after a big topic, and it's an interest rate paper, so that's basically what I do. They have a cool identification, which is neat. That's also nice. And the result is super simple, right? So it's a very easy to read paper, right? So you get the punchline, it's pretty cool. My main comment, I just want to see much more. There's so much more to do beyond the baseline result. So, what is this Treasury convenience yield? The idea comes from commodities. I have two choices to own oil. I can own it physically, or I can own the futures. Now, there's benefits to owning the commodity, right? So supply chain disruptions or being able to deliver quickly, et cetera, and so that we have this idea that the spot price is above the forward or futures price in commodity markets, and that would be like the normal state of affairs. So that's the convenience yield for holding a commodity. That idea carries over into treasuries. There is more to owning treasuries than just owning US government debt. You can repo the treasuries. They have some kind of safe haven status, and they're like money-like instruments. So the idea here is that there is a convenience yield inside or above the fair price, which is a premium that holders of US debt are willing to pay just for having the US debt for the other convenience that it gives them. So that's good for the US government because it lowers their borrowing price or the cost of capital with respect to what would be the fair price. Okay, the fair price. Now the fair price is tricky, right? So what is the fair price? So I like interest rates because they're simple. And this is sort of simple decomposition it's a tautology of what an interest rate is. So on the left-hand side, I have the yield on a long-term government bond, which is equal to just expected real interest rates, to presume expected inflation, a real risk premium, an inflation risk premium, nowadays a credit risk premium potentially, and then this convenience yield. If you can think about the convenience yield as a positive number, then you're subtracting a positive number to lower this yield that otherwise would be the fair price. So this convenience yield, which is generally believed to exist. So that's great. So that's simple enough. And the problem is nothing is observable. So it's a nice formula which is completely useless because we literally do not observe anything on the right-hand side. And I have, tried to work out how to do this in various ways. Basically, it's a tricky problem. So one way to solve this is that you come up with another interest rate product which has no convenience. And so what these authors do, and what many authors do, is that they think about swap rates as an alternative which has the no convenience. So the difference between the no convenience yield asset and the convenience yield treasury gives you a measure of the convenience yield. And so that's what these authors do. They use swap spreads, okay? Now, the second thing is that what might happen here is that in good times, the US Treasury issues into high convenience states to take advantage of that convenience yield. And so you have this endogeneity problem. So you have prices and quantities. And then you have some potentially omitted variables, which is moving these two things about. So how do you solve that issue if you want to say something about the role of supply and fiscal choice on convenience yield? Well, you need some kind of instrument or shocks. And this is where the authors extend some of their previous work with this narrative tax change approach. This is very cute. So this is the summary of the paper. What do they find? Well, the convenience yield is it's heterogeneous in the way that it loads across maturity. Higher supply, a higher debt to GDP ratio implies a lower convenience yield, a more negative convenience yield, but only for long-term bonds. And so the punchline is like short-term debt is money-like, regardless of the fiscal stance of the US government, but long-term treasuries are very sensitive to supply. That has sort of, you could think about one reason that might be is the exorbitant privilege argument, that's disappeared. Or has faded away, at least since the global financial crisis, and the strong debt management implications. Okay, so that's my summary of paper, and everything else is comments. So, comment one is the convenience yield on was always positive pre-2008. So, I'm just taking a plot from some of my previous colleagues, David Lando and Peter Feldhutter, and they have another way of measuring the convenience yield. So, they have a very clever affine term structure model with credit risky instruments, risk-free instruments, all different maturities, and they do some clever estimation. And this is the yellow stuff here is the percentage of the convenience yield as measured by swap spreads due to, the percentage of the swap spread due to the convenience yield. So basically it's everything according to their estimation pre-crisis. So that's like kind of good news, but that was pre-crisis, okay? Now, post-crisis, we live in a different world. Now, I'm showing you the convenience yield measured, the convenience yield, and now I'm showing you the swap spread. I'm not calling it convenience yield anymore. So what happened is, after the global financial crisis, the swap spread, especially at the long run, turned negative. Why is that interesting? Because that's an arbitrage, right? That's a risky arbitrage. So a bunch of people have studied that, and so what I would suggest the authors do is at least acknowledge the rest of the literature, the published literature, and all of these papers down here are looking at these negative swap spreads and making similar arguments that it's changes in end demand from, for example, pension funds or primary dealers, and there are now regulatory constraints which prevent this arbitrage gap being closed. And the question is why? So is it, Angelo has one story why this doesn't disappear, a new story why this doesn't disappear in CIP deviations. There's a bunch of people that have studied the demand side of this, and this is the supply side version, okay? So Angelo's paper and Robert's paper are quite nicely aligned here, but a little bit like Gino's discussion, both can be at play, right? And so I'm very sympathetic for this supply side story to also be in the mix, but let's acknowledge the other existing work, because that's how we move forward as a profession, right? Okay. Some more evidence that essentially both things can be going on. So let me take the previous plot and let's zoom in on 2008. So the grey stuff over on the left of the plot, that's showing you the positive swap spread through 2008, and it's really in the last quarter of 2008 where you see suddenly, now you can't see the grey, but you see the blue line is above the red line, and it's somewhere where I was, I actually started my PhD here because I was fired from Citibank. That was my 3 days in industry. So I was like, as they were bringing boxes down, I was sitting in my desk, and they forgot to fire me, right? So luckily, I had still had my PhD, and so I sort of went down and went across London and said, hi, I'm here. And that's a true story, but you see that's exactly where the swap spread turns negative, right? And it stays negative, okay? But it doesn't mean that all of the variation is coming from. So I want to know where the variation is coming from, basically. Is it the swap spread? Which part of the swap spread is it coming from? You can easily do that, right? And there is room for both of these things to be moving around. This is the result of the author in a picture. Now, the left-hand side is what happens when you don't IV. Okay, so higher supply or debt to GDP ratio, lower convenience yield. There is, a slope. You already see a slope. Now, when you IV, what happens? The magnitude is just much larger. It's basically zero still at the short end, and it's much, much larger at the long end. So the scales of these two y-axes are the same. I mean, I had to think about it. It's not spelled out in the paper, but we know something about why this happens, right? This tells you about what type of endogeneity you face. Because if it's reverse causality, the biases should be, the naive OLS is biased towards zero. Okay, so we know it's not a missing it's not omitted variables, which would probably bias upwards, right? So we know something about the IV-OLS gap. That should be spelled out to the average reader. I skipped this, but there is some, I don't want to sound like an econometric hack, but like there is probably some weak instruments issues going on in the background here. And inspired by Pasquale's talk, I put the cartoon in here. Only one, I promise. So put your hand up if you don't know who this guy is. Put your hand up if you know what Simpson's paradox is. So we have one hand in the room. So one person remembers their stats class. This is Simpson's paradox. I take some data. I've wanted to present this for so long, but here you go. Finally, I got the opportunity. I take some data and I want to study the long-run trend. Okay, and that's what this paper is about. It's about identifying long-run trends. Okay, and so I kind of want to get this, right? But then I take that data and I say, well, now let's chop it up into buckets and redo the regression. So Simpson's paradox is that I can clearly see a trend here when I disaggregate the data, once I aggregate the data, I can flip the correlation. Now, it's not a problem for the paper, because Simpson's paradox is not really a paradox, and it's a well-studied philosophical argument. Actually, it's about how you treat the data and how you interpret trends. And so, given that you clearly are aggregating the data, I think you want to either show us the disaggregated result or show us why the interpretation is not a problem for you. I probably don't have very long, but I think I don't have any time. So I just show you one more picture. The paper is about supply, but that's about quantities. But I think if we think about any like these type of Villanos-Villa style models, it's not about the absolute level of supply, it's about duration. So here I'm computing the mean, the maturity weighted duration. So it's basically like the duration of the outstanding debt of the Fed versus the supply. So the supply is the green line. That's a number which goes up. But you can see that sometimes like supply is flat and duration goes down. Sometimes you see supply goes up and duration goes down. So I mean, it's about debt issuance, but it's kind of our models are written down in terms of duration risk and not supply. And so maybe you want to also rethink about doing things in terms of this thing. So I already gave you my 50 pence. So that's you've had my thoughts. Thank you.
Thanks a lot for a very helpful discussion, Paul. All very useful points. We completely agree with you on the demand side. There's plenty of fluctuations in the data that we think are driven by demand. You can see that on our Seigniorage revenue picture. So I think totally agree. Both stories are at operation in the data. We just wanted to focus on these long-run effects of increased supply. The post-GFC negativity, it's partially why we went after the IV approach to really try to focus on these long-run demand curves. So that's what we were focusing on there. In terms of number of events that we have in there, there's actually quite a few events, because you get one bill, but then it has future variation in the supply due to the CBO forecasts in terms of how they actually operate there. We worried about power of the instrument. On the short end, it's right on the marginal side. On the long end, we don't really have issues. The actual proper KPF stat ranges from about 8 to 20, depending on the particular maturity bucket that we're looking at there. Simpson's paradox, we should definitely run the fully aggregated one. Point well taken there. I've seen it on my computer. It does work. The duration thing, I need to think a bit more carefully about. It's a nice point also related to the Villanos-Villa type models. I think it's an important point. We need to think about how the convenience yield would actually operate in a setting like that when we've got maturity match spreads. I think it's a very interesting idea. So I appreciate all the points. They're very, very useful. Thank you.
Questions?
Ricardo?
Could I have two related questions just on the supply instrument and the exclusion restriction? I mean, just to understand what you mean by an instrument here. I mean, if I have a change in taxes, as you said, motivated by long-run growth, let's conceive that maybe it changes long-run growth. But if it changes long-run growth and a bunch of other features in the economy, it would change the demand that I have for treasuries, because in a more faster-growing economy, I want to demand more treasuries or fewer. So I don't quite understand the motivation of the exclusion restriction here, insofar as these are tax shocks and they will affect GDP growth and others. But related, and I think perhaps a little more interesting, is what do you think is the supply and the demand here? Because I mean, when I have a big tax change, I'm changing the supply of treasuries, but I'm also changing the supply of safety, because maybe these tax changes show me that the government's crazy. They reveal something about the likelihood of default or other. These will shift the supply curve, but I can easily tell stories where these shocks either increase or decrease the supply of what we're actually buying. So can you go a little deeper on what is it that we think is the service that we're buying with the treasuries, so we can interpret your instrument as being a positive or a negative supply shock of what is being supplying? Is it treasury per se? Is it safety? Is it something else? These shocks would be moving them in different ways.
Thank you. Really interesting exercise, and I understand, first stab at anything is already brilliant. But I was wondering, because if you're estimating one long-run demand elasticity, right? And so, almost by definition, the various fluctuation that you see in demand would be coming from shifts in the demand curve, as opposed to necessarily tilting in the slope of the demand curve. But I think we also think that that demand curve is not necessarily static, especially over such a long run, right? There might be some power issues, but I think even simple, say, interactions with, say, the composition of people who are demanding treasuries could potentially get you a little bit way there to thinking about the changing slope of that demand curve as well.
Okay. Yep.
Yeah, very nice paper. My question is related to the first one. I was surprised that you didn't talk more about risk effects of supply increases. Wouldn't that be sort of a natural reason why the swap rate and the treasury yields diverge, as sovereign risk or inflation risk must be clearly affected by supply shocks? But you probably in the paper you say more about that.
Okay, there's a lot to say about all of these things. Certainly, we've wrestled a little bit with some of your long-run growth points in terms of trying to kind of measure like how large the effects of that type of reverse causality could be in the setting of our instrument. We're still wrestling with it a little bit. We've talked to a few people in terms of like trying to measure the effects of these on actual government policy and how it could spill over. Our kind of prior here is it's likely not that large, but it's indeed a concern. So we're wrestling with that a bit. I think in this setting in general, getting a really great instrument for Treasury supply is incredibly difficult. So it's kind of the nature of the exercise that we went, and it's something that we're just wrestling with, trying to emphasize. Okay, look, there is this long run kind of differences in these slopes. If people have other instruments and stuff in mind, we're totally all ears. Totally agree with you, Amy, on the composition point. It's a little bit to the question here in terms of thinking about like what's the nature of the underlying sources of these demand curves, and I think trying to look at that and try to shed more light on it. Also to Paul's point about what happened, over the GFC and this kind of actual shock in the demand curve. Totally. Going after the composition stuff. Our goal here was largely just to say, look, not to say all of this stuff with demand doesn't matter. We just wanted to trace out, okay, there's this long run trend here. Can we actually show that the long run demand curve is downward sloping? And interestingly, we didn't know this, but interestingly, it's much steeper on the long end, which has quite a few implications. Also, to what Paul was saying about like the Vayonas-Vila type models, that's about the intercept here. It actually, if you take our differences in demand curves here as seriously, it ends up having implications for the types of models that we write down. Getting back to how that would affect risk in these sorts of things, we need to keep in mind that this is about the spread between a maturity-matched swap and the government yields. And so I think we need to start to think about how to enter heterogeneity and demand for convenience across maturities into our models. And so that's totally, I couldn't agree more in terms of understanding like what are the underlying features that drive that.